they can continue to price below inflation, which they've been doing for years, and that's kind of eased some of the traffic decline. And and they have great tenure for their employees, right? So the experience is usually good in the restaurant.
So a story of under-promise, over-deliver. You have to get better at that one. Let's talk about the portfolio here, because we talk about Olive Garden all the time. Of course, it's the parent company of Olive Garden. You take a look at comp sales for that specific brand. They were disappointing. Longhorn, though, definitely beating expectations on that metric.
Yeah, consumers seem to be frequenting these steakhouses. They seem to have done better. They seem to do better when there's beef inflation, right? I guess there's a few things going on. Part of it is Longhorn's raising prices more than Olive Garden is, right? And so that's part of the reason why the same-store sales are higher. But also when we see beef deflation historically, we see steakhouses outperform. So I think people are looking at the price in the grocery store versus the price they get at Longhorn. Also, they don't have a 1,000-degree oven in their house. So, Longhorn can cook a steak better maybe than they can. And I think those reasons, we see steak chains do pretty well during recessions, during times of inflation. And, it's not just them, but Longhorn's done a good job.
Yeah, and you've definitely seen that in these results. Talk to me more about the pricing strategy. You mentioned, of course, they can adjust pricing here. It sounds like they have some history of doing that. When it comes to that specific lever, though, how eager are they to do that? How quick would they be to respond?
Yeah, they're not very eager at all. For the last 4 years, they've underpriced inflation pretty significantly, and it's a smart long-term strategy. Management talked about it on the call. It's like when you get into that, you get into that cycle of pricing. Over the long term, people are going to really cut back more on their visits. And so people can view a place like Olive Garden, they can view Longhorn as places that can continue to provide value in this inflationary environment. And, as I mentioned earlier, their scale really helps them do that.
And before I let you go, just quickly, you are fresh off the earnings call. What was the big topic of discussion on that one?
Yeah, I think some of the key points were, they talked about the consumer and how the consumer continues to be weak, especially consumers and households earning less than $75,000 a year, in particular, $50,000 a year or less. They continued to talk about their strategy of pricing less than inflation. They're expecting about 3% inflation this year, and their pricing strategy is for 2.5% to 3%. I'd say those are the two main takeaways. All in all, it's more of the same, which investors should like, right? You don't want any surprises. You want management to continue, on the path that they're on, as long as it's successful, which Darden clearly has been.
Well, Michael, great to speak with you. Appreciate your time. Our thanks to Michael Halen of Bloomberg Intelligence. Now, coming up, we have Frank Monkham. He is Senior Portfolio Manager over at Antimo, why he believes election risk isn't properly priced into the market. This is Bloomberg.
Former New York Yankee about business. And across my career, the deal. Each across sports.
What it was going to be, I put everything I And you know what I'm saying?
And less.
Huge.
Sides. Foreign policy. Bloomberg. All the votes are tallied. Context change. Top names in business are
We're just going to have to hold companies long. Returns are going to be lower over the next few years.
We used to have high prices and have done actually
Joining us now, we have Frank Moncomb. He is Senior Portfolio Manager at Antimo. It's great to see you in person.
Pleasure to be here, Katie.
Let's talk about tech. We were having this conversation with Samir Samana just about 30 minutes ago or so, and he made the point that he doesn't think that what we're seeing when it comes to the fundamentals of some of these tech names actually justify the valuation. So your view, can we call this a bubble?
I think trying to have this around whether it's a bubble or not, it's not really the right discussion to be having. I think we're clearly at the foothills of a bubble at the minimum. The question is it a big bubble, small bubble, medium-sized bubble? We had to look at, where the market is today in terms of positioning, momentum, RSI, everything looks very, very overstretched. The problem is with bubbles is, people think that bubbles are some kind of cataclysmic event happening in the market. It's not, right? It's a feature, not a bug of markets, right? So the way to look at it is say, am I in a bubble, yes or not? And when you answer the question yes, is to have a game plan to be able to trade around bubble markets. And I think we are in a bubble. And the way to trade around it is to look for downside. And the problem, the issue with this market is people are failing to realize how cheap volatility is. So it provides an opportunity to really, protect yourself to the downside at a very, very cheap cost. So I think the question as to whether we're in a bubble or not is not really a question that we should be posing ourselves. It's more so how do we trade around the bubble market.
Well, let's talk about that downside protection, because you take a look at the VIX, for example, it's been doing nothing for quite a long time, currently trading with below a 13 handle, and it just seems nothing seems to shake this market. So when you talk about downside protection, over what timeline are you considering?
That's actually a very good point. I think that, the way to trade around bubble markets, the playbook for that is not to try and short the market directionally. It's to look to play non-linearly via options. And, put strategies are very efficient, especially here, where, like I said, where vol and skew is really cheap. So what you want to do is basically ladder out your risk as you put in on this, they'll put spread structures over time so that you're kind of minimizing your theta decay. And you think about the VIX today, one thing that kind of should be garnering investors kind of the investors kind of respect here in this market is the fact that you have to look at what's going on with volatility in Europe, right? The V2X and the VIX are diverging pretty materially, and this type of divergence really doesn't last too long. So what I mean by that is, in addition to the fact that the market is really straight to the upside, I think as we start to trade into Q3, the market probably is going to be rotating away from this momentum theme into what's going on with geopolitics around the election cycle. I mean, we've got the U.S. here, the debate next week on June 27th. We've got the snap election in France on July 4th, and the election on July 4th, rather, and the France election on July 7th. That's an opportunity really for investors to really try to start to hedge to the downside here as we flip into election cycle in the next quarter.
Well, let's stay stateside because, like you mentioned, the first debate is in 7 days' time, and then, of course, November we have the real deal. And when you think about election volatility, there's not much price now, but should there be? Because you consider a Trump versus a Biden presidency. We know those candidates in both of those administrations.
Yeah, we do. And one thing we do know about either candidate is that it's going to be fiscally. It's going to be fiscal profligacy. We know that profligacy. Whether it's Trump or Biden in there. With Trump side, you've got tariffs. You've got a crackdown on immigration. On the Biden side, you've got the Inflation Reduction Act. That's still inflationary. So I mean, I think it makes it easier for investors actually because you don't have to try to figure out which candidate is going to get in there to get a clearer picture of what the inflation outlook is going to look like. Regardless of who gets in there, inflation is going to be a problem, and the fiscal path of this country is not going to change regardless of who gets in the White House. So again, there's so many signs to point to the fact that it's this time is ripe for investors to really look at some cheap downside protection.
And I have just about a minute left. So that cheap downside protection, when you think about the upcoming election, I was going to ask you, what's the best way to protect for that? Is that through the volatility market or is it through something like commodities, for example?
Well, that's actually a very good point. Commodities also provide a tremendous amount of hedging around inflation, right? But the thing with commodities nowadays is you have to be able to think about what your inflation hedging framework looks like. So if you look at a hedge from an inflation that's coming from a cost perspective, then you want to think about things like energy and ag. If you have an inflation that's more of a demand pool, then you have to think about things like copper and alley, right? But if you have inflation that's more about central banks continue to be, staying in easing mode and kind of losing their credibility, then you got to think about things like gold, right? And I think commodities provide a huge amount of, downside protection when it comes to inflation. And the thing is, with commodities at the time, at where we are in the market today at this juncture, is you have to be really selective on which commodity you actually allocate to. So it's not just a beta allocation to commodities. It's basically trying to pick and choose which commodities make sense here, where you are in the cycle, and where you are the supply demand picture, right? And we've seen what's happening recently with copper and gold and oil, where positioning really has driven a lot of moves that we've seen in these markets. So there's a lot of technicals also that are at play, and that's offering some kind of relative value opportunities that comes from mispricings between these different types of commodities. So I think investors, in addition to saying, hey, we want to be allocated to commodities, I think we should get our hands dirty a little bit more and trying to figure out which commodity makes sense at which time frame here as we head into the second half of the year.
Well, we'll have to pick up this conversation again soon. Frank, great to see you in person. Our thanks, of course, to Frank Monkem of Antimo. And for some of the sector price action this morning, let's get back to Bloomberg's Abigail Doolittle.
We're looking at a modest gain for the S&P 500. Now, Katie, up about 0.3% up for a third day in a row, heading to another record close, carving out an all-time high. Currently, the top sector on the day is energy, up about 1%. Speaking of commodities, we do, of course, have oil up about the same amount, so helping out there. Utilities, interestingly, higher even with yields higher. Those dividends should look less attractive relative to high yields, but the narrative, of course, this year is that an AI play, so anything AI is higher. Real estate and healthcare both down. Those are, well, healthcare, defensive sector, so the fact that it's down, that is almost a risk on signal, but small moves. As for one sector that's making a bigger move over the last few days, that is the home building sector, currently higher today, but over the last 2 days, down 1.9%. And Lennar a couple of days ago, of course, put out results that were not received well by Wall Street, but KB Home today, that stock up nearly 5% as they maintain margins despite incentives to sell their homes.
All right, Abigail, thank you so much. Coming up on this program, the market-moving events you need to be watching. That's in our trading diary. This is Bloomberg.
real events that influence your world. On Bloomberg. With a growing and questions about you need to keep in and around China. On Bloomberg.
All right, it's time now for the Trading Diary. What you need to be watching today and the rest of the week. We get oil inventories later on this afternoon, plus Fed Speak with Fed heads from Barton and Daly later on today. We round out the week tomorrow with earnings from CarMax and, of course, existing home sales, because already Friday coming up tomorrow. Meanwhile, this was the Countdown to the Open. I'm Katie Greifeld, and this is Bloomberg.
Mornings. I understand you have
down. So and Saturday, and I start typically by playing that, have a nice lunch, and then Sunday I would send culture where I think what that if your direction is just too narrow, I'm a better leader than I generally believe I'm a much better.
All right, we are 30 minutes into the U.S. trading day on this Thursday, June 20th. Here are the top stories we're following. Stocks poised for new highs, driven by tech gains and optimism about rate cuts after the Swiss National Bank trimmed rates for the second time this year. A taste of M&A, Tate & Lyle buying the specialty ingredient company CP for nearly $2 billion. We'll set the table with Tate & Lyle CEO Nick Hampton. And Global EV Alliance, LG Electronics and ChargePoint are teaming up to install new EV charging stations in the U.S. We'll discuss with the ChargePoint SVP of the Americas in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets at this moment, and there is green on the screen behind me. You can see the S&P 500. We're at an all-time high, currently up about 0.3%, actually outperforming big tech with the Nasdaq 100, currently up by about 0.2%. I can't say the same for small caps. Of course, also down. And then you take a look at the 2-year Treasury yield, also higher, about 3 basis points or still below 5%, though. Let's get to the earnings picture, though, because it's a mixed bag for Darden Restaurant reporting this morning. The company delivering a beat on earnings. However, Olive Garden's store sales fell for the second consecutive quarter. Joining us now is Michael Halen. He is restaurant analyst for Bloomberg Intelligence. And Michael, seems like this was better than feared overall.
Yeah, for sure. Casual dining same-store sales have been weak all year. So I think that's a big part of it. It was kind of a relief that they were still able to beat on the bottom line, even though the top line is being pressured by, weak low-income consumer spending.
Yeah, I was going to ask, is there anything you can sort of extrapolate out to the broader economy and the state of the consumer here? For example, in retail, we talk about all the time the trade down that we're seeing. Are we seeing a similar sort of dynamic play when it comes to the restaurant industry?
Yeah, and restaurant sales have been weakening for a year now, right? So typically, as usual, restaurants are a canary in the coal mine. Their sales tend to fall off before other sectors, in a slowdown. So and this year has been especially tough. Consumers are dealing with 4 years of inflation and price hikes at the restaurants, and they're dealing with these higher prices by racking up credit card debt, and credit card delinquencies and auto loan delinquencies are rising. So low-income consumers are definitely under pressure. They don't see the same value at a restaurant visit, and so they're trading down to the grocery store and probably making some more meals at home right now.
All right, Michael Halen, really appreciate your perspective. Of course, Michael Halen of Bloomberg Intelligence, and we do want to bring you some breaking news. This is coming from the Supreme Court. The Supreme Court upholding the 2017 U.S. tax on foreign business income. Of course, we're expecting several Supreme Court decisions, and there's one of the first ones, again, that we're getting today. The Supreme Court is upholding the 2017 U.S. tax on foreign business income. We're going to bring you more details as we get them, but let's turn now to the broader markets, because joining us now we have Dana Diorio. She is Evestnet Co-Chief Investment Officer and Group President. Dana, great to have you with me. I'm going to start with a stat from a Bloomberg News story this morning, and that roughly a third of S&P 500 companies have hit a one-month low past month. And we talk about breadth all the time and how it just isn't there. Is that something to be concerned about, or is that just the state of the market right now?
I do think it is something to be concerned about. And, certainly I will say my discipline in terms of investments and approach to investments has really always been around fundamentals, value for, right? Valuations matter. Over time, things like quality matter. And we're just, and it's not to say that the top of the market, the AI, the big tech is not coming forth with the earnings to support, because they are, right? The earnings are there to support, the growth that you see there. But to see the lack of look at what the equal weighted S&P is doing versus, the market cap weighted, I think it obscures for the average investor, because they're in the market or they're in some actively managed portfolio that has low tracking error to market probably on a relative basis. It's not a ton of idiosyncratic risk. It looks like the market's doing great, but in fact, a lot of the economy is not really participating.
Well, let's talk about that, the divergence that you're seeing between the S&P 500, of course, your large caps, and then you have the equal And then you have your small caps who just can't get off the ground. What's the catalyst? How do those lines come back together? What is it actually going to take, Dana?
Well, the first thing you think of is interest rates, right? Small caps tend to be much more interest rate sensitive. They need to go back to markets for, credit more, and therefore the dependency on what that rate and, what those, what the corporate finance team there is looking at in terms of rolling over debt, higher that cost is going to be. So, one of the clear drivers obviously is, do we get rate cuts? It's interesting because you see the market sort of assuming maybe we do get a little bit more, maybe it's 2 this year, 1 possibly before the election, 1 after, but it isn't at the moment acting as the catalyst for small caps that you would hope. I think to the extent that we get really kind of solid evidence that the Fed is ready to start making some cuts, I think that is what will help small caps.
But it's so interesting because we're 3 months or so away from the first rate cut, and we're just not seeing, like you say, really catalysts come into place for small caps. And you think about the potential timeline here for when we might actually see the rally broaden out. Apparently 3 months ahead of the first rate cut is time to do it. So when is?
Yeah, a part of what you have to think about with all of this too is the market in general. So we're looking at small caps as sort of lagging, and the equal weight, which obviously overweights relative to market cap weight, is a lot more small cap bias, low price bias, and we're sort of looking, oh geez, they're lagging, and really it's probably more the inverse, right? We're seeing massive outperformance amongst growth, tech, AI-driven outperformance that really, when the economy, when you look at, well, how will that growth story, if that's what's propelling the market cap via these names, how does that trickle down to these other companies? And I don't think there's a clear story there yet. There's certainly going to be winners and losers, but without that storyline, the question becomes well, what is the catalyst, and what type of a market are we actually going into if we think about things just from a perspective? Well, we see retail sales are down. We see consumers are worried. The bite of inflation, right? Yes, great to have a moderating inflation report. The day prices are significantly higher than they were just a few years ago, and that's not going away, right? And then, unemployment, there's no way to argue that unemployment hasn't stayed rooted and a very strong picture for the Fed, but without the thought that and there's an argument to be made that the Fed's even a little bit behind on some of these rate cuts, without the thought that the Fed is going to 100% start cutting rates, it becomes a question of, well, what do I expect then, an increase in some of these other stocks when I have the story there, right? I don't have the thesis for that.
Well, let's talk about the dominant storyline in the market, and that, of course, is AI. We opened up with a conversation about tech and, what we're seeing when it comes to some of these big chip makers, but how far can you follow that AI storyline? I hear more and more about utilities, data centers, even copper, for example. I mean, how far does it go, Dana?
So it's interesting because obviously copper has been experiencing a boom this year, and we're going to have this, right? We're going to have this storyline, a narrative around, hey, everything is AI because you need copper for AI, right? And you need energy for AI, and so therefore the energy companies get a boost. And as these things do, right? Any aspect of the supply chain that you can somehow attach to that AI story potentially gets a boost from this. So I would say this is the time for really kind of a fundamental look at these different, theses, right? And to say, okay, well, what companies actually do stand to benefit from this, and what companies are being lifted up in this, hey, all boats that have anything to do with AI can float higher. As an investor, I think you have to be careful. I think there are ways to play AI. Think internationally. Think some of these semiconductors, the story is there, but they're not really pricing into something to the extent of, say, an NVIDIA, right? So there's definitely opportunity and ways to play this, I think, but you also have to beware that you're not getting caught up in a storyline that, maybe it's related, or maybe copper the supply chains,
Right. Yeah, no, it's a good point too, that the opportunities are out there, but of course you have to be selective. It's very difficult to pick winners. Dana, have to keep the conversation going at some point later. Dana DiOrio of Investnet, thank you so much. Let's take a look at what's moving now underneath these markets with Bloomberg's Emily Grafeo, and we were just talking about AI, so tell me about the poster child.
NVIDIA. No denying that this is essentially the stock that all investors are going to play this year, and essentially last year's too, AI frenzy. It's up about 3% right now. Not sure if there's any exact fundamental news on this day, but the big news this week is that it's now the world's most valuable company, over $3 trillion. More than $2 trillion of that value has this year. And what's remarkable, Katie, is that that's bigger than the total market cap of Amazon, total market cap of Meta. If you go back to its IPO in 1999, it's now posted a total return of, I don't even know if I can say this number correctly,
Five digits, right?
Yes, 591.78% thousand. I'm good with these larger.
That's a lot. That's
but
a lot.
It is a 6-digit gain, including reinvested dividends, and over 170% year to date this year. It is just a remarkable ride for the
An incredible momentum chase going on as well, with another 3% or so added to NVIDIA shares today. But keeping the conversation going on AI, Accenture, I mean, it's the same sort of story here.
It is. And when you actually look at their earnings, it wasn't all good on the top line, at least. You look at adjusted EPS and revenue, that was a slight miss, but investors didn't seem to mind this morning because when you dig in, Accenture posted a beat on their new bookings for the third quarter. Generative AI new bookings totaled $900 million versus about $600 million in the second quarter. Bookings overall were up 23% since last year, and also beat estimates. We're seeing that stock up about 10%. When you look at what analysts are saying, the report is than feared. Vital Knowledge said that while the income statement wasn't terrific, the very robust bookings number, pointing out the generative AI bookings, should help the stock trade well. It's an AI morning, Katie, because my next stock is also about AI.
Tell me all about Dell.
Okay, so we have that stock up high. This is about a partnership with Elon Musk's XAI startup. This morning, in a post on X, Musk said that Dell and also Super Microcomputer, which is another stock that is going crazy this year, they're going to be providing server racks for the supercomputer that his AI startup is building. And then this followed a post by Michael Dell that said Dell is building an AI factory with NVIDIA to power the supercomputer. There was a picture of all of these processors.
Very exciting.
That he posted. But this is really this is a broader story of these hardware companies, these server companies, increasing their output as more, I guess, customers want to build AI. They need these servers to have a higher data processing capacity, basically to just handle the computer processing that needs to power AI.
Yeah, can't wait. More details on that one. But in any case, the shares are higher this morning. Bloomberg's Emily Grafeo, thank you so much. Now coming up, a sweet deal in the food biz. The UK-based sweetener maker Tate & Lyle announcing that it will buy U.S. competitor CP Kelco for $1.8 billion. Nick Hampton, he is Tate & Lyle's CEO. He joins us next to break down the deal. This is Bloomberg.
Bloomberg Real. From hours a day, Bloomberg.
Europe, I'm Tom McKenzie.
Close to the European Trading Day. Unmatched expert at 6 a.m. London time.
Managed trading.
And analysis changes everything.
Well, UK-based sweetener maker Tate & Lyle announcing today it will buy specialty ingredient maker CP Kelco for nearly $2 billion. Joining us now, I'm pleased to say we have Nick Hampton. He is Tate & Lyle's CEO. And to catch our audience up to speed, of course, Tate & Lyle, you help food and drink manufacturers really remove sugar and fat from their products, replace them with alternatives that replicate the taste and feel. So how does this deal aid you in that core competency?
Casey, thank you. This is the perfect fit for us and for CP Kelco. They bring really, really strong capability in creating texture and mouthfeel in food and beverage products. And as you think about the move towards healthier and tastier food, it's critical not just to replace the sugar in terms of its sweetness, but also all of the texture that makes the consumer experience as good as it can be. So think about replacing the fat and sugar in a yogurt, and you need to create that creamy taste. Well, the combination with CP Kelco can help us with that. And as we think about the future of our business, being the best at what we do in terms of being able to help customers reformulate for health and for clean label and for nutrition is really important. So bringing the two companies together really adds to our capability to do that and makes us more customer relevant and will therefore enable us to grow together.
Let's talk about some of the sell-side reaction. Of course, you have Barclays out saying that this deal looks like a good fit when it comes to scope and size, a reasonable valuation multiple. But you take a look at CP Kelco, and there has been some volume decline and also margin pressure. How do you reassure investors about what we're seeing on the CP Kelco side of things?
So look, I mean, the CP Kelco is a fantastic business. Let's start with that. They've suffered in the near term from some of the market softness that we've seen, both driven by destocking and driven by consumer softness because of all the inflationary pressures. So all of those things have led to some temporary volume and margin decline, but we've got a very clear pathway to drive growth together going forward. We've worked very closely in partnership with them to build a joint plan for how we're going to do that. And, that starts when the transaction closes. The other thing I'd say is they're seeing some improvement in performance this year. We're seeing stabilization of volume, revenue and margin. So that recovery is already starting.
And let's talk a little bit more about the structure of this deal, because that has raised some questions as well, because CP Kelco's parent company, that is JM Huber, as part of this deal, they're going to become a long-term investor, have a stake of about 60% or so. Can we get more details on the conditions of their ownership? For example, can they buy more shares, or are there any restrictions on sales, for example?
So I say two things that are really important. Their continued participation in the business is a clear belief in the potential of the partnership together to drive growth. It's a real validation of why the two companies together can grow and succeed. That's reflected in their continued equity participation because they want to participate in the success of both businesses. There are customary lock-up periods and sell-down conditions as you would expect in a transaction like this. So there's a lock-in period for 2 years, but actually committed to the longer term here. So we're very excited about partnering with them and in their faith in us in taking control of a significant part of their business.
All right, appreciate that. And you've also said that this deal, it's going to generate cost synergies of about $50 million by the end of the second financial year after it actually completes, which I believe is expected in the fourth quarter. Can you tell us a little bit more about where the opportunities for cost cutting actually are, where those synergies are going to come from?
So we've worked very closely with the management team at CP Kelco to lay out a pathway for this, and it really comes from three areas. The first is benefits of scale when it comes to things like procurement, and the benefits of actually to source together. The second area is in the scale efficiencies we can create in things like back office. You know, we've got a shared service center, and we can really benefit from putting the two businesses together. And then thirdly, there's a big commercial overlap between the two businesses. So, you know, we've both got structures that will allow us to become stronger together and become more efficient as we grow. So it's a real benefit from the two companies coming together in a complementary way.
And Nick, you say overlap and I think layoffs. So when you think about headcount, for example, are you expecting reductions there?
Because always as you put two businesses together, you're looking for efficiencies everywhere. And, you know, we've been through a number of these kind of experiences over the last few years. Is that we get the best people in the best jobs, and we take care of everybody through that process. Of course, we're going to become more efficient as we come together.
And I do want to talk a little bit about the M&A environment right now. You and I were talking in the break that you haven't seen a lot of M&A, both stateside and over you are as well. And when you think about why now for this deal, I mean, what was the decision tree there?
I mean, it's really a combination of factors. The first is, as a business, we've completed our transformation to focus on specialty food ingredients and the future of food, and therefore the time for us is right. As we looked at the industry structure and talked to each other, we also believe that being more relevant for customers by bringing combined portfolio together will allow us to grow faster together. So it's a choice on both sides at the right time. And the great thing is it's come together in a way where we've done, if you like, a bilateral agreement that both companies are very happy with at a time that suits both of us.
Well, Nick, really appreciate your time on what I know is a very busy day. Our thanks, of course, to Nick Hampton, the CEO of Tate & Lyle. Now, still ahead on this program, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
or other authorities.
This is a 3-0.
At 1 p.m. and 5 p.m. from
I mean, this is going to be
day at 1 and 5 East. The top
That every company needs to intelligent software company.
All right, it's time now for Social Climbers. Look at the stocks making waves on social media this morning. And first up, McDonald's is going to the mat, escalating a bitter or in the fast food biz. The burger giant is kicking off a marketing blitz with a new $5 meal that will include a McDouble cheeseburger or a McChicken sandwich, small French fries, 4 chicken nuggets, and a small soft drink. Eat your heart out. Next up, Amazon shoppers can expect less plastic in their packages. The e-commerce giant announcing today it's replacing its plastic air pillows with recycled paper. The company also said it will eventually replace the hard-to-recycle white and blue plastic mailers with paper sleeves. And finally, the black market for weight loss drugs is thriving, and Eli Lilly is sounding the alarm. The pharma giant is warning about the dangers of fake and compounded versions of its diabetes and weight loss medications. Eli Lilly is announcing new lawsuits against wellness centers and medical spas that advertise their drugs. Eli Lilly also says it never sells medications on social media. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. It's hard, so let's look at the markets right now. The S&P 500, it's still green, but just so. You can see it's up about 0.1%. We were higher by about 0.3% earlier, but giving up some of those gains. Meanwhile, you take a look at big tech, and we flipped into negative territory. The NASDAQ 100 currently off by about 0.1%, all as yields continue to climb higher. That 2-year Treasury yield higher by about 3 basis points. Now coming up, EV charging wherever you roam. ChargePoint and LG partnering to make that a reality. Rich Moore, he is ChargePoint SVP Americas. He joins next. This is Bloomberg.
Brand. The pair
abilities to better outcome.
Multi jointly assumed the C
and in designing products in the most efficient way. Mark has different strengths.
or unusual. Complement each other.
Makes you a better CFO. Understanding the numbers.
Special Equality Series. Celebrating in
Well, ChargePoint and LG announcing a new This week, the two companies are aiming to make EV chargers more accessible to consumers. And here with more deal is Bloomberg's Abigail Doolittle.
Well, Katie, the stock is responding positively, up about 1% the last time I looked. And to your point, yes, there is this announcement that LG Electronics has partnered with ChargePoint, its EV charging network in the U.S. The initial result of this partnership will introduce charging solutions that combine ChargePoint's charger management software with LG advanced EV charging hardware. Deliveries are expected to happen later this year. And you can see here that we have on ChargePoint teaming up with Airbnb to add residential charging to listings and collaborating with Porsche North America on service integration. So this EV charging company, really lots going on for it. Let's take a look at this stock along with some of its competitors. One direct stock on the year. You can see some declines, some serious declines. ChargePoint down 5%, EVgo down more, down 43%, Blink down about 19%, Bloom Energy, an indirect play, down about 7%. I would argue, though, one point on ChargePoint, the reason we have this decline is there's a pretty significant short interest. So not everybody's buying in on the idea that there's going to be success here in terms of these announcements. In blue, we're looking at the stock price, and white, we're looking at the short interest. The short interest is currently 28%. So that's really pressing, I would argue. But if they continue to do announcements and perform, you could really see this flip. I would remind everybody of Tesla back in the day, an even higher short interest, and clearly overcame that.
Yeah, Abigail Doolittle, thanks for that context. Of course, we all remember the days of those Tesla shorts, but let's focus on this, of course, partnership. We're going to do that with Rich Moore. He is ChargePoint SVP Americas, and ChargePoint, of course, it manages more than 306,000 EV charging ports across the U.S. and Europe. And Rich, it's great to have you with me. So I'm curious about how people charge their EVs right now. Is the bigger opportunity in the commercial space or in the residential space where you have partnerships?
Yeah, so a lot of the charging starts at the home, and it's certainly a major part of all charging solutions. So we look at charging for most of the consumers where people are going to eat, sleep, play, and work, and that's in a bunch of different areas. So if you look at some of the partnerships that we've done so far, and you look at some of the deployments that we've done so far, it really supports charging in all those different areas. So our business really is around enabling customers to be able to either stand up charging commercially where they want to access customers, and enabling homeowners to be able to stand up charging in their own place so they can charge at the lowest cost possible.
And when I think about the business of EV charging, it almost feels like a chicken and an egg sort of situation, because you have analysts arguing that your operating success, it really is on EV adoption to spur the greater need, of course, for chargers. And then, of course, I would imagine your standpoint is something that it's range anxiety that is depressing EV demand, and that's what's going to unlock it. But just walk me through your calculation here and how you're thinking about sort of the depressed EV we've seen.
Yeah, so we've actually seen, Q1 demand on our network, which is, we provide hardware and software for customers that want to electrify. So ultimately, we don't own the stations at the end of the day. We don't sell or monetize energy. So when we looked at our network, the 306,000 ports, the Q1 demand was actually up 20% year over year, which implies that, there's more vehicles, being sold that are putting pressure on the existing network. So, and that's excluding home. So if you look at that, what it really says is that the market's starting to stabilize from a demand standpoint. And then you should see the next group of chargers start to follow as the demand continues to increase. The traditional OEMs are seeing growth year over year on the EV side. Most of them are. Obviously Tesla, was down a little bit year over year, but they sell a heck of a lot of vehicles throughout North America. They're the biggest dominant player. So it's not like EVs stopped selling. It's been, the demand has started to increase every year, and we expect to see, with the demand on the current ports that are available in North America, we start to see more ports being needed through the back half of the year and into next year. This will start to stabilize as EV adoption increases over the next couple of years.
Well, I'm glad you brought up Tesla, because I'm thinking about the competitive landscape here as well. Of course, in addition to selling cars, Tesla has its supercharger network. You have other competitors out there as well. What does it look like to compete? How do you do that at this stage of the industry?
Sure. So there's a DC on route market where you're going to see a lot of high power chargers deployed. And then you're going to see an AC market continue to mature throughout hospitality, events, arenas, kind of everywhere you go and spend a long duration of time. So we see the markets developing, equally in both of those as far as continued deployments, but one's going to grow a heck of a lot faster than the other. So the best place to charge is where you're going to spend the most time and on purpose. So when you have to use DC charging on route, it's because you're going someplace where you need to supplement normal charging that you have access to. So we see the business cases being built out, separate from each other. There's a case for DC charging, all the places that those go. So that's the EA model, the EVgo model, the Tesla model. And then we see a strong AC market through all the use cases in North America. That's everything from commercial to work. This is a huge part where we see charging growing. Employees are starting to rely on that more than ever as a place to charge. And then hospitality and convenience segments are continuing to grow and seeing good utilization on AC ports. And then DC utilization is starting to increase as more cars are being deployed and more pressure on that network.
Well, you make a good point that, of course, you want to charge where you spend the most time, and that's because it takes a long relative time to charge your EV. And you think about range anxiety. It's not just how many charging ports there are. It's that I don't want to be stranded waiting for my vehicle to charge, of course, whereas I can get gas in just a couple of minutes. And when you think about shortening the time that it takes to charge, how long of a process is that to finally get it on par with just refilling your gas container?
Yeah, I think the experience is a little bit different. I have 2 EVs and I have a gas car still. I have three cars in the family. You get kind of used to every morning your car just being full, and you kind of take it for granted once you've been an EV driver for many years. So when I'm at home, I don't really think about how long it takes my car to charge. I come home, I plug it in, and it's just full every single day. So that's the easy part of the equation. The place where consumers have to really think about what their EV experience is when they're doing longer trips, which is not the norm in the U.S. that people are doing, over 200 miles or 300 miles at a time. But when they need DC charging, what is the place where they're going to do that charging, and they're going to want to spend some time. So if you look at traditional, fueling on the gas or diesel side, they're probably in and out in, 10, 12 minutes, depending if they, run into the store. So taking that to 20 minutes, what is the experience that these retailers want to provide for their customers? That 20 to 30 minute range is kind of on average what you're going to see. So when we look across like all the usage, all the DC usage that we see in the United States, you're seeing average dwell time anywhere from 20 to 40 minutes. And 40 minutes would generally say that someone came in, very, very low on state of charge. They're down in, the high single digits, in the low double digits, high single digit range. So they're spending a substantial time at the pump. But what we're seeing at the charging station is a behavior of that 20 to 30 minutes. And we think that's acceptable if they have the right experience and the right, things to do where it's convenient to a coffee shop, or they can grab something to drink or use the restroom. That's, I think, what you're going to see there's going to be much more of an experience deployed around DC charging.
And before I let you go, I do want to talk a little bit about the share price, because you take a look at shares, they're down nearly 82% over the past year. That's an industry-wide conversation. But what do you think investors broadly are missing about the space?
So I think what they're missing is we enable businesses to be able to stand up electrification for their business, whether that's in fleet, commercial, or home. So and you look at the LG partnership, why we did that. LG aligns perfectly with us, what they've done for, many, many years on how they serve their clients on home, on retail, and healthcare. These are all places where we knew that there was going to be more advancements in technology when it came to hardware and other energy management and power and all the stuff that LG does. So when we look at this, this is about a better together with LG in solving the problems on helping businesses stand up electrification. So ChargePoint, we don't have to make a bet on energy costs. We don't have to make a bet on utilization as that gets deployed. So as long as we're providing world-class hardware and software and solutions, whether that's with a third party on the hardware side or with our own, as long as we can continue these businesses seeing the value of providing this for their customers, ChargePoint's in a pretty good place long term. Now, there's tons of pressure around utilization and auto, and obviously a lot of the politics around EV in the U.S. But I can tell you, after being an EV driver for many years, it solves a lot of problems that consumers need to solve as far as a convenience and certainly long-term over a cost standpoint. So the vehicle prices will continue to become more competitive in the United States. The technology will certainly continue to be better over many, many years. And, charging is going to be a big part of people's lives for a long time.
All right, Rich, I think that's a good place to leave it. Appreciate your time today. Our thanks to Rich Moore of ChargePoint. Let's get a check on these markets. We're going to do that with Abigail Doolittle.
So we're looking at the Nasdaq 100 down ever so slightly. If the decline holds, it will be the first down day in 8 days. But take a look at the S&P 500. Last time I looked, it was slightly higher. So we have this pull and tug between indexes up just a little bit. So it'll be interesting to see which direction wins out. In terms of this rally and an all-time high here for the S&P 500. Interesting to note, the index is higher, so is the VIX. The 2-year yields higher as bonds sell off a little bit. That's probably one pressure on stocks, especially big tech, the valuation. And then oil up about 0.8%. If we take a look at the S&P 500 and its range, it's really an impressive breakout here. Take a look at this breakout out range. This is a formation that typically would break to the downside. We don't know if it's a real breakout yet. One thing I would say is take a look at the RSI at the all-time highs then back in December, much higher than where it is. A fancy way of saying that the current buyer's not quite as confident. And if we break it down relative to stocks, well, we do have, not surprisingly, with the S&P 500 up ever so slightly, Accenture higher on strong bookings, and I play NVIDIA, the world's most valuable company, but Broadcom giving some of those gains back, and then Apple, this is the one I really want to point out, down 1.4%. This stock may be starting to break down out of a big rally. More needs to be seen.
All right, keep your eyes on Apple. Abigail Doolittle, thank you so much. Coming up, Glenn Hubbard. He is Columbia Business School professor of finance and economics. He joins us to talk about why education should be a top priority on the political agenda. This is Bloomberg.
Don't like answering. Intelligent.
Especially myself, and I want to be the one speaking.
Producing intelligence is it's now intention-driven.
See other people use.
So you need
together. It's causing
Bloomberg. Context. Centralized finance. Covering all things crypto. Transactions.
Really awareness is going to grow.
Bird Crypto, Tuesday. markets and the political. Anne-Marie Hordern only.
All right, it's time now for our daily Wall Street Week conversation. And today, focusing on the evolution of economic models and higher education. Glenn Hubbard, the Columbia Business Professor of Finance and Economics, he sat down with Wall Street Week's David Weston earlier.
The historical debate over mercantilism is one we're living through again today. Traditional response from economists is you need to focus on markets. Yet, as economists, we often make that sound very abstract. And why should you care about markets? The reason is that they are delivering the best outcomes for all of us in the economy. Now, markets don't always work perfectly. The title of the piece I wrote was Markets for the People. When would you step in? You'd step in for national defense reasons, for example. You would step in to support basic research and innovation. But we need that kind of a new focus. We don't need to go back to Hayek and Friedman on the one hand or the mushroom industrial policy of the Biden administration on the other.
And there are massive slowdowns. I mean, the Great Depression, the great financial crisis. I assume where you would say, yeah, the government does need to step in there. You can't just let the market bail us out of that.
Well, correct. But let's go back to the intuition economists like Keynes had at the time of the Depression. It was really the notion of the state being a kind of actor of last resort in a true crisis. Really awful events, the state steps in. But now the state keeps stepping in. When does the state not step in? That's not what Keynes had in mind. And it's not a question about budget as much as it is dulling the competitive senses of the private economy if the state is always going to bail us out.
Is it a question of democracy as well, ironically, in the sense that people see that they can get bailed out, then there's sort of an impetus to have their elected representatives bail out. People want to get reelected, so you say, let's make sure we smooth over all the rough patches.
Exactly so. The problem is we can't do it. If you look ahead in the next 20 years of the nation's fiscal policy, we are going to need to spend more on aging Americans. We are going to have to raise spending on defense. No one seems excited about raising taxes. This math doesn't work.
How do we create a society where we have equal opportunity without guaranteeing rights?
Great question. I think we need to have a right to opportunity, much as we have property rights in markets, but a right to an opportunity is not the right to a result. So to be specific, a right to an opportunity could be much more support for education, for training, for places that have been left behind, for the government supporting much more in the way of basic research. All of that's very different than a system that says results only matter.
How do you compensate for very large differences in where people start out in the process? I mean, differ of where we start out, no matter where we went to school, where we grew up, whatever. But there are some huge differences here. People are well behind in terms of their wealth, in terms of their background. How do we make they have an equal opportunity that compensates for what they've been deprived of for generations, the black-white divide?
It's a great question. There are a lot of reasons we have black-white wealth differentials, some of which, sadly, come from public policy errors over decades. I don't think we can fix that overnight, but I think what we can do very quickly is make sure that everybody has access to the same opportunities and have a system that encourages work, encourages wealth building for anyone who wants to do so.
Glenn, through so much of your work, you often come back to education. Education is not just getting a bachelor's degree. It can be trade schools, various education. You talked, for example, land grant schools in your book, The Wall and the Bridge. But whenever we have money to spend, we don't seem to spend it on education. We find all sorts of other things. We can have wars we spend money on. We can spend all sorts of money on infrastructure, which is a good and useful thing. I don't ever hear that coming up to the top of the list in the agenda politically.
Well, it's got to, and we've done it successfully at least twice. So the land grant college movement was a decision by political powers that be that the country needed a different set of skills. We were going from an agrarian economy to a manufacturing economy. After the Second World War, the GI Bill was the same kind of intervention. Today, with globalization, with technological advance, and especially new developments in artificial intelligence, intelligence. We need that kind of moonshot approach to education, and it's got to come up to the top of the list. Unfortunately, in the 2024 campaign, I'm not hearing it.
Hear it either. That's right. But let me ask you about that, because higher education in this country right now is under a microscope. There's a lot of criticism of it from all sorts of different directions. Would it make sense to write a big higher education right now without reform of higher education? Because not all of us think it's heading in the right direction on its own.
I completely agree with that, but I don't think elite private universities are the problem or the solution to what we're just talking about. Rather, it's community colleges, it's vocational training. That's where we need to be spending a lot of money. Writing big checks to the Harvards and Columbias of the world from the federal government, I'm not sure it's good for that problem. It may be good for basic research or things like that, but yes, elite universities need to get their house in order and fast.
And that, of course, is Glenn Hubbard. He is Columbia Business School professor of finance and economics. And, of course, Wall Street's David Weston, who is sitting to my left. And that was an interesting note to end on. Of course, he is at Columbia University, but like he said, writing a big check to a Harvard or a Columbia, maybe that's not the solution here to when we're talking about the higher education issues.
And in fairness to Glenn, he's never been talking about that. He thinks there are other approaches that make a lot more sense, like trade schools, like community colleges. But what you heard there was an implicit criticism of both Bidenomics on the one hand and also President Donald Trump's approach to this. You heard at the beginning, he was talking about Merkelism. He's talking about Donald Trump and the move to replace income tax, for example, with tariffs. On the other hand, he finds Bidenomics and industrial policy rather fuzzy. So he's trying to find a different course. He's got a paper coming out tomorrow, actually, on foreign affairs, trying to come up with a third way for economics.
Yeah, we'll definitely keep our eyes out for that one. But it's interesting. I just walked through the Trump and the Biden campaigns. And like you discussed with Glenn, it's like education not exactly on the priority list of either campaign necessarily.
We've spent so much money in this country on so many things, including the Iraq War. I mean, trillions of dollars, literally. And imagine if we'd taken just a portion of and really devoted it to education, really building that up. And it would address some of the issues we also talked about with a real disparity in where people are starting out in the supposed competitive race. We want to have equal opportunity, but that doesn't help much if you start 50 yards back from where your competitor is.
Yeah, very good points there. Great conversation. And who else do we have on Wall Street?
Well, tomorrow we're going to turn to France and actually Western Africa, believe it or not, with Ian Bremer of the Eurasia Group. We talked to him about that of France, but also something we may have missed, which is Russia moving into Western Africa. That's coming up with Ian Bremer and the Eurasia Group.
All right, looking forward to those conversations. Our thanks, of course, to David Weston. This is Bloomberg.
On Bloomberg.
Credit spreads are kind of. I think there are a lot of inflation. Whatever the world is pricing higher than people think.
Bloomberg. The world with the moment news is everything.
All right, let's take a quick look at some stocks hitting highs and lows this morning. And first up, we have the Williams Company hitting a 52-week high after it was raised to buy at Argus Research. You also have Eli Lilly hitting highs after the drug giant broadened its efforts to crack down on fake and off-brand versions of its GLP-1 drug Zepbound. Now, on the other side of the coin, you do have Warner Brothers Discovery hitting a 52-week low. That's after Seaport Global cut its price target to just about $12. You can see over the past 2 days that stock down about 1.7% or so, trading at $7 a share. Meanwhile, let's take a broader look at these markets right now. You do actually have higher volume. According to my screen, volume up 37% compared to its 20-day average. Not exactly translating into big price moves if you take a look at the broad indexes. The S&P 500, it is higher, but not by much. You can see the S&P 500 currently higher by 0.1%. Meanwhile, the NASDAQ 100, I'm going to go ahead and call that unchanged. Interesting, even though, of course, we are seeing NVIDIA build on its momentum, build on that rally that to be the world's most valuable company, you aren't seeing the follow-through necessarily when it comes to the NASDAQ 100, currently unchanged. And meanwhile, you take a look at the 2-year Treasury yield higher by about 3 to 4 basis points, just at about 4.75% on that 2-year yield. Now coming up, Nancy Tengler, Laffer Tengler Investments CEO and CIO. She joins Bloomberg Technology with Ed Ludlow next. That does it for Bloomberg Markets, though. I'm Katie Greifeld, and this is Bloomberg.
Get out of just I had a which is a big jump. The surgeon brought have a measure of motion necessarily what they bring to the table of everything in teams. Focused. Number 2, accountable to execution. Did you take the tumor out? Information. Those things that sort of a passion.
On Bloomberg.
In New York, I'm
News, data, and context changes everything. From the heart of where innovation, money, and or collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde's off. This is Bloomberg Technology. Coming up, car dealerships across the US halt services after a cyber attack. Full coverage ahead. Plus, OpenAI co-founder Ilya announces a new AI research lab. We have that exclusive reporting. An AI startup, HeyGen, hits a $500 million valuation in its latest funding round. We do discuss the CEO. A very quick check-in on markets. The S&P 500 very briefly hit the 500 historic mark and then pulled back. We're flat on the NASDAQ 100. Broadly, we're kind of treading water after a US holiday. The story, though, is individual names in the AI infrastructure play. We're talking about Dell, we're talking about Supermicro, and of course, we're talking about NVIDIA. Later in the show, details of what played out 24 hours ago on social media. Michael Dell saying that Dell is building an AI factory for Grok and XAI and Elon Musk. Back on social media and saying Supermicro is part of the story as well. And you can clearly see Supermicro, the kind of big beneficiary of that move that's coming up. The top story in terms of news flow is what we were talking about ago. Car dealers across the United States were affected by a second cyber attack after an initial attack yesterday compromised the CDK software platform. Halted business. These are some of the publicly traded dealerships and auto retailers impacted in the here and now, all moving to the downside. Let's get to Bloomberg's Jeff Stone on our cyber team. Okay, let's start with the latest because it's moving quite quickly. There was a second report of an attack this morning. What do we know?
That's right, Ed. This is a big, messy cyber attack. You mentioned there's a second incident just reported. That happens as this software provider that works with more than 15,000 dealerships around the country is already trying to recover from what looks like is going to be a pretty costly outage. The nature of the incident isn't quite clear yet. We know that dealers are waiting for more information from the company, but we know it looks bad.
Jeff, as I said, you're kind of a key member of our cybersecurity team. What was the vulnerability here? What was the security breach, and where did it happen?
The nature of the breach, the point of entry, is certainly still under investigation. This incident fits with a recent string of attacks, certainly in the healthcare sector, that are targeting kind of customer service software providers and almost innocuous companies that a lot of your viewers won't think about on a daily basis. These companies sit at a key point in various supply chains, and when they are hit, there are ripple effects, costly ripple effects that have major impact throughout their supply chain.
Jeff, as you know, I've covered the automotive industry for quite a long time, and I've learned so much about CDK, 15,000 customers, front office, back office. Also, like the names that have been impacted here on the name brand side are big ones like Subaru, Toyota. What have the responses from the companies been, and what have they actually been telling customers as well?
Please give us time and some patience. We know that dealerships, like I said, are waiting for more instructions from their parent companies, from CDK, as this continues to unfold. For now, a lot of dealerships are slower to make sales. We know that representatives are increasingly working with paper transactions rather than the quick automatic stuff that we've all become used to. So it's very challenging. They're waiting for more information.
Jeff, this is one hack in a series of hacks over years that you and I have discussed on the show. In terms of its scale, where does it sit in those that you've covered in recent years?
Growing. The healthcare sector, like I said, has been the main focus over the past year, 18 months or so. The cost of this, based on the number of dealerships certainly affected, seems to be high. We're waiting to see if there will be any government action on this or any guidance from the Department of Homeland Security, for instance, in terms of understanding the full scope of the incident. But for now, it's still calculating.
Bloomberg's Jeff Stone on a developing story. Thank you. Big story we're tracking is over in China, where e-commerce giants have been slashing prices in celebrity endorsements to boost enthusiasm for the 618 shopping festival. Bloomberg's Henry Wren joins us for more out of London. This is a newer one for me, Henry. I've been reading about 618, but if you were to summarize, you'd basically say that the consumer in China getting an unprecedented level of incentive this week from the big e-commerce names.
Yes, indeed. So we're seeing things that we have been expecting, for example, the price cuts. PDD, which is known for its budget shopping site, Pinduoduo, has been keen to let its customers know that it has been putting forward the steeper than ever price discounts. But also we've been seeing something very unexpected. Let's say, for example, JD.com's founder, Richard Liu, is appearing on live streaming e-commerce. But it's not him exactly. It's a digital avatar of him. Also, in the meantime, a pop star, Rihanna, who's pretty famous and popular in China as well, is seen selling a Chinese style of pancakes in front of camera. So basically, we've been seeing everything here with all sorts of promotions.
We're talking about the names that we always discuss on this program: Baba, Pinduoduo, JD. That's the company side of the story, but there's also the Chinese consumer side of the story that we track so closely here on Bloomberg Technology. Is the idea that they're needing to discount so heavily, get so creative in their incentive, a sign that the Chinese consumer needs a bit of help?
Yeah, indeed. So the story that we have been reporting all over is the Chinese consumers are quite cautious in terms of picking deals. And this has been a trend that has been confirmed by the 618 event as well. The main message across the merchants has been price cuts, which has been across those live streaming platforms as well as these three big companies. But also in the meantime, we see local media reporting that some categories, for example, women's apparels or luxury goods, have been seeing very high return and cancellation rates as high as 75% to 80%, which really shows that consumers are quite cautious. Yes, they probably are spending because of price cuts, those promotions, but they're pretty keen in terms of picking the cheapest deals, necessarily the best in terms of quality.
Bloomberg's Henry Wren, who is all across the China tech beat. Thank you so much. It's great to see you again. All right, coming up on the program, we're going to be joined by Nancy Tengler from Tengler Investments. Really interesting move into an interesting name that's top of mind this morning, and I'm really looking forward to the conversation. Stick with us. We'll be right back. This is Bloomberg Technology.
I think to Robert Kardashian and people running studios often paid attention to education. I was a housewife, but at the same time were happening right times I've learned from. And so
World Cup. This is a talking tech. And first up, Masayoshi Son may be on the cusp of making a major investment in AI. Telling shareholders at the annual meeting, the SoftBank founder says they're looking for their, quote, next big move in tech. The comments come after the company saw a string of losses through the startup bets. Plus, OpenAI co-founder Ilya Sutskever has announced a new venture called Safe Super Intelligence. The company aims to create a secure, powerful AI system with no intentions to sell AI products or services like rivals OpenAI and Google are currently doing. Sutskever left OpenAI in May, just shortly after the return of Sam Altman and the ouster he was involved in. And finally, Dell announced that it's building out an AI factory with the help of NVIDIA to power Elon Musk's xAI, with Supermicro Computer also providing servers. The two companies have been adding server capacity recent months in an effort to win more businesses making AI expansions. Remember that I sat down with Michael Dell last month, who defined an AI factory as the following.
You get into the ecosystem of all the software and the models that you're hearing about, the small and large models, the retrieval augmented generation. Of course, it's not just GPUs, it's also the networking, storage and the memory that come together.
So let's be honest, that was a lot of words, but we're about to have a conversation where I think we can get to the root of what we're talking about, and that's with Nancy Tengler of Laffer Tengler Investments. And it's interesting, Nancy, because you actually got into Dell following earnings May 30th, and there was kind of a mixed reception to earnings. There's a growth story there about AI infrastructure, and there were some near-term concerns. But let's start with why you looked at Dell and thought, hey, this is the move I'm going to make.
Well, Ed, thank you for having me. A couple of reasons. I mean, we were late to the party, and that will happen from time to time. We've been late to other parties, but the point is that you get there. And we saw it as an opportunity to step in, not just on the data center side of the business, but the PC upgrade cycle part of the business. And so if you look at hyperscalers, they are spending or spent about $200 billion on AI in their budgets. And so we think the use case is real, the technology's real, the monetization is real. And so this was an area we were underway hardware in our tech exposure, and this was an area where we could jump in.
So you do not hold NVIDIA, which is really interesting. The big story we're talking about this morning is what played out on social media Wednesday, that Michael Dell posted they're building an AI factory, xAI, to power Grok. And Musk responds and says, well, actually, Supermicro is involved as well. So let's do some math, which actually my colleagues at Bloomberg Intelligence kindly walked me through this morning. If this deal is for Grok 3, Musk has said in the past he'll need 100,000 H100 for that. And if you assume the average price of a server rack's about $1 million, there are 30 NVIDIA GPUs in each rack. You'll need 2,700 racks. That could mean $1.5 million in bookings for both Dell and Supermicro if BI the $3 billion deal value. So you don't hold NVIDIA, but you kind of do indirectly. Is that fair?
Yes, I'm going to take that because, it seems silly to not be in NVIDIA. We have very strict valuation metrics, and so I'm waiting for hedgies to go to the Hamptons and then hoping we'll get a pullback in NVIDIA. But I think that is the important thing to be thinking about, that the investment cycle, as the large language models become larger, the power needed to generate the metrics around that is going to augur well, not just for NVIDIA, but for Broadcom, which is, we own the poor man's NVIDIA, which is Broadcom. And I'm pretty happy with that holding. It's up 65% year to date, or 70, but that pales in comparison to NVIDIA's 170%.
On the valuation question, when last I checked, and I don't in front of me now, but I think NVIDIA trades at something like 45 times 12-month forward earnings, something like that. And so it's a based issue for you. You just called Broadcom the poor man's NVIDIA. Just extrapolate a bit why you'd say that.
Well, it's certainly not as much in the sweet spot, but Hock Tan, who, by the way, is the highest paid CEO in corporate America, he is a master operator of the business. So they've already made, VMware's been on the books for a quarter. It's It smooths out the hardware cycle, and they will be facing some competition, certainly, from NVIDIA in the networking side of their business. But we just think it's a company that it has paid. I mean, we've owned it for a long time. It's a member of our 12 Best Ideas portfolio, and continue to like it here. It's the cheapest of the group. And I love these old economy or old technology names like Broadcom, Oracle, Dell, who have remade themselves. And thanks to strong management teams who pivoted when they should have pivoted, just like Satya Nadella at Microsoft, which is another 12 Best Ideas name for us.
One of the other top stories on Bloomberg today is this research note from Citi, and they argue that AI is going to displace more jobs in the banking sector than any other sector. And I was looking across your portfolio, and you have this 12 Best Ideas portfolio, which includes Sachs. So if we stick with the AI theme, what do you make of that Citi call? That it's banking where an impact to the workforce is most felt from AI?
Yeah, I don't think it's going to be the Goldman side of banking. I've been in this business for 40 years, Ed, and I've heard all sorts of prognostications about what will happen that never happens. I think artificial intelligence will augment workers, and particularly the kind of professional workers that Goldman employs. So I don't think it's a bank teller, robocall side of the business that will be potentially impacted, but that's not Goldman, at least not anymore since they've exited retail banking. And we think the M&A activity is certainly going to accelerate. So we still like it here. It's still very cheap based on our work, and so I'm not worried about that.
Henry Wren, who covers China Tech for us, on talking about the Chinese consumer and how many of the big Chinese tech names are doing heavy incentive this week. If there's one thing that keeps Nancy Tengler up, I think I'm right in saying that it's the consumer broadly, but I guess principally in this country. Why is it such a concern to you, the state of the consumer?
Well, so I think there's two consumers. There's baby boom consumer, which I'm a member of, who has half of the country's net worth. So they're spending, they're retired, generally speaking, and they're not being impacted by this. They have big stock portfolios, but it's the low-end consumer that's just getting crushed by, inflation, which is still with us. Only on Wall Street do we say, oh, inflation's declining because the rate of change is going up less fast than it was previously. So I think it's wearing on them. Interest expense, the access to credit, all of this has declined. And then we know that, full-time jobs declined in March year over year by 275,000. Hours worked declined. Wages in terms of average hourly earnings declined. So this is a problem spot for the economy. And, the low end of the consumer is en masse much greater in numbers than the baby boomers. So I think we have to watch this. The retail sales numbers, though they're not comprehensive, disappointing, and the revisions down were also disappointing.
Earnings season is again around the corner, it's silly to say. Take that concern and give me your expectations. Technology earnings in particular?
Oh, I think tech's going to continue to shine. And just for the record, we've been advocating overweighting tech since the fall of 2022 when everyone wrote it off once again as not the place you wanted to be, that the tech trade was over, that higher interest rates were going to hurt technology companies because that was an old school view of the world. But in fact, most of the mega cap names have benefited from higher interest rates. So we think earnings is going to continue to be a bright spot through this year and next. And so we want to own, the hyperscalers. We want to own the hardware companies. And, they wrote off software a few weeks ago, but just wait a few weeks. And I think the guys will be back in buying software. So there's my cynical view of the way this world works.
Cynical, maybe. I appreciate the admission that you were late to the party on Dell. In the end, you made it to the party, and that is what matters. Nancy Tengler of Laffer Tengler Investments, thank you so much. Stick with us. We'll be right back. This is Bloomberg Technology.